Joining us now is Interactive Brokers Chief Strategist Steve Sosnick here with us. Great to have you here, Steve.
Great to be here with you, John.
So you say today is a rip up the script day, and to me it was a reminder also of why you stay invested. Don't try to time the market. It seems to me that the fundamental problem, though, from here of trying to invest based on fundamentals is you don't know what the fundamentals are going to look like at the end of the year for companies that sell stuff, right?
Absolutely, and that's kind of the problem we've been dealing with here is, could you imagine an environment, even 3 months ago, the prior earnings season, if companies were just sort of withdrawing their guidance, throwing the papers up in the air and saying, we don't know, and the markets would be like, yeah, we're fine with that. That's unbelievable. But the momentum now is so strong, and the trends have been so strong that basically people are willing to suspend fundamentals. If you're just investing on momentum, you're saying the trend is your friend, stocks are going up because they're going up. I'm quite okay with that, and I'll worry about the fundamentals later because the price action is doing all the work for me.
So what kind of thesis can you sort of believe more in this market, whether it's domestic, international? What do you sense is a thesis that remains true?
I think international actually remains a good thesis here because I do think that while we're past the worst of the foreigners saying, get me out of this market, we're moving our money back home, I do think that now that we've come so far so fast, they're not going to be in a rush to put it back in here. They're doing quite okay in their home markets. The dollar has certainly gotten a lot stronger today, but I think there's still a lot of back and forth going on here. We're basically 2% above where we were on before Liberation Day, and yet the tariff situation is kind of worse than we were expecting then. So this, again, is pure price action. And so, it's one of these situations where I don't want to fight the trend, but maybe I want to start insuring against it when you have VIX flirting with 20 when it was, 60 or so.
Yeah, 10% tariffs is the new normal in the best case scenario, depending on the trade deal with the country. To your point, you've talked about it, and we've seen it in the market. We've seen this divergence in recent weeks between institutional investor flows and retail and individual investor flows. And retail has continued to buy on the dip. Is that what you're continuing to see at Interactive Brokers? And if so, where has the appetite been?
We've absolutely seen net buying pretty much the whole way through. Our customer base, I don't want to just call them retail because they do range from small retail to huge institutions and everything in between. And they're very, I'm going to call them pro-tail. They're sort of professionally focused in many ways. But they've been net buyers the whole way through. They've never given up on this market. They've been embracing the volatility. So in any given day, TQQQ, the 3x levered QQQ, is more active than QQQ on our platform. There's more people trading that than there is QQQ. So they're basically saying, all right, the volatility is insane. Bring it on. I want more. And this is, in any given week, sort of 4 or 5 of our 25 most active stocks are leveraged ETFs, whether it's at TQQQ, SQQQ, the Tesla or the NVIDIA double levered. They want this exposure, and that's one of the ways they're going after it. And they've been aggressive, and we see net buying almost every one of our top stocks almost every day.